Welcome to today's explainer. If you just casually scrolled through the crypto news over the last 24 hours, you'd probably think the entire market packed up and took an early vacation. But let me tell you, beneath the surface of today's incredibly quiet spot market, there are massive macro forces and some fascinating prediction market bets quietly building up right behind the scenes. We're looking at the landscape as of August 16th, 2026, and trust me, we are looking at the literal textbook definition of the calm before the storm. To give you a sense of just how staggering this current market standstill really is, just look at the weekend data. Derivatives liquidations plunged an unbelievable 71% to just $38 million, while overall trading volume practically halved. When liquidations drop this drastically, well, it means those sudden, violent price swings that usually shake out the leveraged traders have completely evaporated. Everyone is just waiting. I mean, if you only looked at the major assets, you'd absolutely assume the market went into hibernation. Over the last day, prices have essentially frozen in place. Bitcoin is basically glued to roughly $62,900, barely moving even a fraction of a percent. Ethereum is just hovering right near $1,878. And XRP, it's fighting tooth and nail to defend that psychological $1 line, sitting right at 99 cents. All right, moving into section 1, catalysts building the pressure. Let's talk about the macro forces looming just out of sight. So, the reality is we have a massive convergence of economic, political, and global events hitting all at once next week. These are completely impartial market movers. Just look at the pileup on August 19th alone. We've got the FOMC meeting minutes dropping, which will give us a much deeper look into the Fed's 3.50% to 3.75% interest rate range. On that exact same day, there's a highly anticipated White House meeting between Donald Trump and leading crypto executives. Throw in the fact that the odds of the crypto-focused Clarity Act passing have just plummeted to 10%, plus some very serious geopolitical tensions in the Strait of Hormuz involving the UAE seizing Iranian offsets, and yeah, you've got a powder keg just waiting for a match. And you can really feel that geopolitical anxiety underlying the market right now. With traditional trading volumes down today, traders are heavily flocking to prediction markets to hedge their bets. On Polymarket, the crowd is pricing in only a 13% chance that the US-Iran ceasefire actually extends past its August 20th deadline. So what does that mean? It means traditional equity and crypto markets are going to have to price in this massive 87% risk very shortly. And hey, the stakes are just as high on the regulatory side for the platforms themselves. Kalshi, which is a major prediction market, is currently facing a fierce regulatory battle. The CFTC ordered it to keep operating amidst a lawsuit that exposes the market to over $36 billion. $36 billion. So not only are people using these platforms to bet on regulatory outcomes, but the platforms are literally in the crosshairs of monumental legal battles themselves. Which brings us to section 2, placing bets. Prediction markets as the crowd's crystal ball. Because with traditional crypto spot and derivatives volumes dropping off a cliff over the weekend, we really have to ask ourselves, how are traders actually positioning for the imminent breakout? Where exactly is the smart money going when the retail market completely stalls out? Well, we're seeing prediction markets become the new ultimate trading tool. And they aren't just for niche crypto natives anymore. They have officially bridged the gap right into the mainstream. On one hand, you have a retail giant like Robinhood now offering event contracts, literally letting everyday users open their app and bet on whether Bitcoin will be above $55,600 by a specific hour. And on the other hand, you still have Polymarket, the granular crypto-native platform where traders are betting on highly specific hour-by-hour price thresholds. And when we look at the live crowdsourced probabilities on those platforms, it tells an incredibly specific story. Traders are putting their money where their mouths are. They are overwhelmingly betting at 98% odds that Bitcoin holds its narrow floor above $62,600 by tonight. But look at that drop-off. It's practically a cliff. They're expressing extreme doubt that it rallies, giving it only a 7% chance to break above $63,000 and a tiny 4% chance to hit $64,800. The crowd's consensus is absolute gridlock today. Any sudden breakout is going to catch a lot of people completely off guard. Let's jump to section 3, quiet institutional accumulation, what the whales are doing. Because this right here is where the long-term game is actually being played. We are seeing incredibly aggressive Q2 ETF acquisitions by absolute heavyweights. We're talking Morgan Stanley adding over 111 Bitcoin via spot ETFs. Paul Tudor Jones increasing his BlackRock Bitcoin Trust holdings by nearly 19%.
UBS raising its exposure, and the Bank of Montreal officially disclosing new XRP ETF exposures. While retail traders are bored out of their minds by the consolidation, institutions clearly see this as a prime accumulation zone. They are quietly stacking their bags while the rest of the market sleeps. And it's not just Bitcoin. Even as XRP dips just below its psychological $1 support to 99 cents, institutional demand for it remains amazingly resilient. We've seen $2.2 million in positive weekly inflows into XRP investment products. The big money is completely ignoring the short-term price chop, which basically tells us they're betting heavily on post-consolidation utility. Finally, Section 4, breaking the range. What's next? Let's look at the bull versus bear scenarios.
Okay, so technical analysts are currently watching a massive symmetrical triangle forming on the Bitcoin chart right now. If we use a simple if-then approach, it gives us our critical levels. For the bear breakdown, if Bitcoin breaks below the $61,850 support trend line, sellers gain control and we expect a pretty steep drop down toward $56,900. But for the bull breakout, if it cracks the $66,700 ceiling, we're looking at an estimated 7.9% rapid trajectory up towards $71,900. Seriously, write these down. $61,850 for the bear drop and $66,700 for the bull run. Those are your exact lines in the sand.
Now, despite the stagnant price action we talked about earlier, check out the derivatives positioning on Ethereum. The long-to-short ratio on Binance sits at a massive 2.56. That literally means for every short position, there are over 2.5 long positions. Traders are heavily positioned for the bullish breakout scenario here. They're perfectly willing to pay the funding rates and just wait it out because they believe the eventual release of this pressure is going straight up.
To wrap up this explainer, I want to leave you with this thought. We've got massive institutional accumulation happening right behind the scenes, heading straight for an absolute wall of looming macro catalysts next week. When the irresistible force of these upcoming global events finally meets the immovable object of our current range-bound market, which side of the breakout are you betting on? Keep your eyes on those key levels we discussed, and we'll see exactly how this storm breaks. Thanks for exploring this with me today.